Bloomberg's Wall Street Week up ahead a little more than an hour from now. The host of Wall Street Week, David Westin, joining us right now for our daily Wall Street Week segment. And you had a chance to sit down with the former Treasury Secretary, Larry Summers, and get his thoughts on some of the economic data we got.
Exactly. We had a big week with the IMF and Ex-Im Bank, but also we have to remember there's a lot of economic data that came out, the CPI, the PPI, Atlantic Fed, and even the retail sales today. And we asked Larry, basically, does this indicate that, in fact, the Fed may be winning its battle against inflation? Larry essentially said, not so fast.
I think it's very hard to read, David, but I think I see some growing evidence of stag, but some real continuing concern about inflation as well, and that's a tough combination. On the stag side, it does look like defaults are rising. It does look like the flow of credit is coming down. Headline retail sales were not strong, although the internals are less clear. So I think you have some grounds for concern about what's happening with real activity on a forward-looking basis. And while the CPI and the PPI numbers surprised a bit in a favorable direction, you saw one-year inflation expectations from the University of Michigan pop up, and the Atlanta Fed wage tracker, which I actually think is a better indicator of what's happening in the labor market than the monthly average hourly earnings, that popped up a bit last month as well. So I think we're still looking at a very hard to read economy. I don't see inflation as on a secure path down to the 2% target unless the economy turns over a bit. So I think the Fed has very difficult choices ahead of it.
So, Larry, let me make it even more complex, perhaps, and that is where we are with credit right now. There's a lot of reports right now that credit standards are going up in the wake of those bank, if I can call them tremors, that we had. How do you factor that into it? Could that help the Fed a bit, really curtail some of the inflation?
Look, I don't think there's any question, David, but that some Fed work is being done by tightening of credit to small and medium-sized businesses, tightening of credit certainly to not profitable technology companies, tightening of credit, very importantly, to commercial real estate, and some evidence that tightening of credit to consumers and automobile borrowers. So there's definitely that effect. The question is, how large is it? I thought prior to the tremors in the banking system that there was a chance the Fed funds rate would have to get up to 6, and that it was certainly more likely than not that it would have to get to 5.50. What's very hard to know is whether that action in credit, which is reinforcing the Fed, whether that's 3 moves worth of reinforcement, whether it's only 1 move worth of reinforcement, and that's the judgment the Fed's going to have to make on an ongoing basis.
Larry, in your opinion, how does money supply figure into your analysis of the economy overall? There was a lot of talk this week by some economists actually saying that, in fact, the fall in the money supply, particularly M2 with respect to the United States, really indicates that, in fact, we're going to go, if anything, into a recession, that we're not going to have to worry about inflation anymore.
David, I would describe myself as post-monetarist. I think when we started paying interest on reserves, and so if a bank or somebody had an account at the Fed, it was kind of just like a interest-bearing account. And so money was no longer special by virtue of not paying interest. When we had that change in our economy, I think this whole concept of monetary aggregates as substantial predictors of what's going to happen lost a lot of its force. And so I'd have to say that money stock is pretty far down on my list of indicators to follow.